Good afternoon. We're going to talk in this video about corporate type information and the cash flow statement. One of the first things we need to address in a discussion of the corporate information is par value. Par value is arbitrary. It's a stated value, and it's typically done to avoid taxes. So, for example, I often tell clients, state that the par value of your stock is a penny when you sell it. Now, that doesn't mean you sell it for a penny. And so if you look at this example, the company has sold it for $100. They've sold 100 shares of 1 penny par for $100. So, if they receive $100, they're going to go ahead and debit cash for 100. They're going to multiply 100 shares times a penny and come up with $1 in common stock as a credit. Then there's another credit of $99 to paid-in capital in excess of par. So many young accountants wonder, why do I have to go through this nonsense? Well, you just do. The simple answer is, if the company wants to save taxes, they're allowed. There are federal rules in place that say states cannot tax paid-in capital in excess of par, but they can tax common stock. So, rather than something nice and easy, like debit cash 100, credit stock 100, we have this transaction, debit cash 100, credit common stock 1, credit paid-in capital in excess of par common for 99, to make the journal entry balance. Let's think for just a minute about dividends, which are a major part of the corporate stuff. So if there's a basic cash dividend, this is really a simple transaction. We debit retained earnings for $1,000, credit cash for $1,000. Now, I didn't show you that if we just plan to provide a dividend, we will debit retained earnings and credit something like common dividend distributable. There are also stock dividends that can be provided. And some reasons that a company might do a stock dividend is to keep the stock price affordable or to show confidence in its stock. There are 3 general types of stock dividends, although a stock split is really something different. In a small stock dividend, which is defined as 25% or less of the previous outstanding shares are now distributed, the journal entry is to capitalize retained earnings, is the term often used. So capitalize retained earnings for the market value of the shares. So we wind up with a debit to retained earnings, in this case $15,000, a credit to common stock dividend distributable of $5,000, if indeed we haven't provided the stock yet. Otherwise, it would just be common stock that we credited. And then, for anything above par value, we're going to credit paid-in capital in excess of common stock. A large stock dividend is defined as 25% or more of the previously issued outstanding shares. Here, we capitalize based on par value, not based on market value. And so the simple answer is, we look at a large stock dividend as more meaningless, almost like a stock dividend. And the rules don't let us capitalize market value in that case. So there's not as much of a debit to retained earnings. Here, again, we just debit this for par value to retained earnings rather than market value. Let me point out here that legal money laundering is occurring here. So there's nothing wrong about this, but if you do the small stock dividend, you wind up with a big reduction of retained earnings, and we basically transfer retained earnings to new stock. But the reason I'm calling it legal money laundering is that when you debit retained earnings, you reduce the amount of the corporation's equity that an owner would have to pay a dividend on if they, or dividend tax on, if they received it. So you might have heard the expression dividends are taxed twice, taxed very heavily. This is true. And the small stock dividend causes smaller taxation on the dividend. A stock split, we really don't even do a journal entry. We divide, for example, if it's a 2-to-1 stock split, we're going to divide the price of each share in half, and we're going to double the amount of shares outstanding. Preferred shares are often provided as an enticement to cause somebody to buy stock. The enticement is that the shareholders have a stated right to a dividend. So they'll get a dividend before common shareholders will get one. Cumulative preferred shares receive rights to share for any period of dividends missed. So if dividends weren't provided for 2 or 3 years, when they are provided, if it's cumulative preferred, the preferred shareholder receives all 3 years of dividends before common shareholders receive any. And if it's non-cumulative, there's no right to dividends. Treasury stock is the last topic in the common stock type or equity type section, corporation type section. And in treasury stock, a company buys back its own stock. Now, the 2 primary reasons it does this is either to influence its market price. Think about what you've learned in economics. If there's less shares outstanding, each share is worth more. If there's more shares outstanding, each share is worth less. So if a company buys back its shares, there's less shares outstanding, the price of each share, in theory, goes up. Another reason to do this, though, is to satisfy stock options. So a stock option will be a case where a company will allow its owners to, or sometimes its management, to buy a share of stock at today's market price a year, 2, 3 years later. And if the stock price is rising, that means it could be very expensive for the company if it had to go buy its shares out in the stock market to provide the option. Instead, it can buy back its stock here for that purpose. Notice in this case that the journal entry is to debit treasury stock, in this case for $5,000, and credit cash. The transaction C provides an example where later on the treasury stock is reissued at a price above what it was bought back at. So notice here there's a debit to cash for $8,000. That's more than the company paid for it. So, excuse me, it credits treasury stock $5,000. Credits paid in capital $3,000. Well, let's switch gears and start thinking about the statement of cash flows. So we're going to focus on the indirect statement of cash flows, and here we have 3 basic types of cash flow. Cash flow from operating activities, cash flow from investing activities, and cash flows from financing activities. Cash flows from operating activities are all the normal things that the business does on a daily basis. It's regular operation. So on an indirect statement of cash flow, this section is reconciled, you might say. It's not deliberately counted. So we start with net income, which we assume is all operating activities. And then we add non-cash expenses like dividends. We subtract non-cash income, like gains. And we add or subtract non-cash current assets and all current liabilities. The bottom part of this page shows you the same thing that's in your textbook. It shows you how to adjust changes in non-cash current assets or current liabilities as adjustments to net income. So we see that non-cash current assets, if there's an increase in those, we subtract the difference from net income. If there's a decrease in them, we add the difference to to net income. With regard to current liabilities, if there's an increase in these from one year to the next, we add this to net income. And if there's a decrease from last year to this year, then we're going to subtract the difference from net income. And that'll be our cash flows from operating section of a cash flow statement. Cash flows from investing activities and cash flows from financing activities are done no differently whether we have an indirect statement of cash flows or whether we have a direct statement of cash flows. So, well, your book talks in an appendix about the direct statement of cash flows. And I mentioned in the introductory video that FASB prefers the direct statement. There's really no difference in the investing section or the financing section. So the investing section shows cash purchases or sales of buildings and machines. That's what's in the investing section. Cash flows from financing activities are any cash in from investors or banks and any cash out from investors or banks. And here, you don't really pull anything off the income statement. You need direct data from your accounting department. In the past, at times, very important things that were usually done with cash were sometimes done in a different way. So we now are required to have non-cash investing and financing activities disclosed at the bottom of a cash flow statement. And so an example of a non-cash investing activity is if you borrow to buy a building. And an example of a non-cash financing activity is when you pay back a debt. The company receives payment on a debt for stock instead of cash. Now I'm going to show you a second video in just a minute, and this video will show you actually how to do an indirect statement of cash flows. Good luck. Let me know if you have questions.